Hello Sector Watchers, welcome to the show. This is the 99th episode of Sector Spotlight for Tuesday the 5th of October, recording it on Monday the 4th. My name is Julius de Kempenaer and I'm presenting to you from Amsterdam in the Netherlands. The 4th of October is World Animal Day. Regulars may know that we have moved to a farm, a former livery or boarding stable for horses about 2 years ago. And as it's World Animal Day, I thought I'd share a few pictures of what we've got running around here. We've got 4 horses. One is a Spanish Cruzado called Belenia. We got a Haflinger horse called Tine. We've got an Icelandic horse called Raggi. And we've got a Dutch KWPN breed called Furia, who's actually pregnant at the moment. So we're expecting a filly in a few months' time. And then there's 2 little eeny-meeny Shetland ponies called Ollie and Bliss. 2 dogs, Pepik and Madelief, and 1 cat, Yapi. I'm sure they had a pretty good day here. They got some extra treats, and now it's time to start with the show. It's going to be all about monthly charts and looking at last week's rotations, of course, at the start of the show. Enjoy it. This is Sector Spotlight. For the look back on asset classes, let's start with the daily RRG of asset classes on the right and the weekly RRG of asset classes on the left. If we kick off with the daily rotations, they're ending on Friday, October 1st, then if you just look at the table, you see that both commodity ETFs have gained significantly, 2.4 and 2.2% for GSG and DJP. And at the bottom of the list we find real estate V&Q and ITOT, the stock market, with -2 and -1.5. No surprise that the benchmark VBINX, the Vanguard Balanced Index Fund, which is a 60-40 balanced index fund, so 60% stocks and 40% bonds, lost 1.3%. Just above that is the complex of fixed income asset classes. If we look at the rotations, no surprise that we have both commodities still moving higher on the RS ratio scale at relatively solid RS momentum. That's a good thing. A bit of a weird zigzag here in DJP, but the bigger picture is for both commodities to move higher on the RS ratio scale, which is a good thing. The strong move of the US dollar is catching the eye. We've mentioned that a few times already here in Sector Spotlight, and that move now really seems to start materializing. So let's have a look at that later on. But the tail on the RRG here for the daily is pretty clear. Strong rotation, at least over the last 5 days. But when we scroll back, you see, let's highlight the dollar here. That picked up, had a little bit of a hiccup, and now the general move is for the US dollar to gain versus VBINX, which is a good thing. Then here is where the fixed income tails are located: GOVT, high yield, corporate bonds, all inside the leading quadrant, losing a bit and then picking up, which is where we left off the week with a pickup of relative momentum. And the same goes in the opposite direction for real estate V&Q and the stock market ITOT. We started the week pretty good for stocks, and then at the end we bent to the left again, which is pushing ITOT further into the negative here on the daily RRG. So here is the rotation for stocks. Last, I think, so like 10 days, 10, 15 days, pick up, and now we start moving to the left. So how does that translate for the weekly tails? DJP, no doubt, very strong. Let me select this one has got both. So we got DJP and GSG both with long tails pushing higher inside the weakening quadrant, and we know that's a positive thing. That means that they are picking up and reigniting the already existing relative uptrend after a little break. V&Q continues at a negative RRG heading. No surprise after the weakness that we saw here on the daily for V&Q. Nevertheless, still a very strong asset class if you just look at it in isolation in this RRG. And then we see the further deterioration, or maybe I should say new deterioration for ITOT. You see it's a very short tail, so it's a very stable move, but it's starting to move to the left. There is still a little bit of room for ITOT to pick up before it hits the lagging quadrant, so we'll keep an eye on that in the next couple of weeks. But the near term is suggesting a little bit more weakness for the stock market going forward. And then we have here in the improving quadrant, we've got the US dollar. As I said on the daily, it's picking up strength, so it's doing well there, and that is translating into a renewed move. And look at the increase of that segment here on the tail. That's a good thing. And we see government bonds, high yield, and corporate bonds all moving higher on the RS ratio scale. Corporate bonds losing a little bit of momentum. High yield and government bonds doing pretty well here on the weekly RRG. Now, following these rotations, there are two charts that I would like to share with you. And the first one is the one for the US dollar. If you look at the weekly chart of the dollar index, then you can see that I think we can now safely say that this double bottom has completed and has executed, and the US dollar is on the way up. You can see the improvement, gradual improvement versus the benchmark, although that is less of importance for the US dollar, I would say, but the general direction for the US dollar is higher. I think there is a resistance to be expected, let's say around 95. The level here is 94.83. It's rounded off at 95, but the pattern here is very clear. We got a double bottom, two touches, and we break higher, sending the US dollar index higher. If we check that out on the euro dollar chart, then we can see that that big head and shoulders that we've been looking at is now definitely there. We're breaking below every previous low on a closing basis, which is signaling a downtrend for euro dollar, which is an uptrend, a rising move for the US dollar. It points to US dollar strength. And we can also see that coming back in the daily, where especially the big move here on the 29th was very, very clear, and we're now following through. Let's see, I think that now 116.06, let's say 116 is a resistance level to watch, maybe 116.64 in case of real strength of the euro, maybe a little bit of dollar weakness, but the move, the general move, the big picture is very clearly in favor of the US dollar. Now the other image, which is still on my, well, two images actually. One that's still on my radar is the number of new 52-week highs. I noticed that divergence a few months ago, been monitoring it ever since, and you can see that it has now reached new lows, it's pushing to new lows. That moving average, that 12-week moving average is continuing to push lower, and that is not consistent with an uptrend, and you see more weakness coming into the S&P500, which is the black chart that you see here on the back. That's SPX. And the other one is the divergence between ITOT and so the ratio of ITOT versus GOVT, so the stock bond ratio, and then the divergence with the RSI. I think that is a very striking image. It's getting stronger and stronger. You see that now the RSI has dropped below all these lows since January, actually, dropped below 50 for the first time. The ratio itself is dropping out of that channel that's already at a slower pace than it used to be. So everything is pointing to a rollover of this ratio and to a little bit more weakness ahead. Where it will stop, I don't really know, but I'm watching levels like 3.5 here in that ratio. That's something that when I will assess the situation again. And while we're at it, Let's have a look at SPY, the weekly chart. We see the break, that's going on for a while. We're again here looking for 420 as a next support level, but more importantly, the RSI now starting to move lower, the MACD starting to move apart, showing a divergence between the MACD line and its trigger line. All in all, that's pointing to a little bit more weakness for the S&P 500 ahead. Level to watch, I would say 420 in the S&P 500. Let's quickly move over to an assessment of last week's rotations for sectors before we go into the break. And after the break, we'll be looking at the monthly charts. On the right-hand side, we have the daily RRG showing the daily rotations. On the left-hand side, we have the weeklies. On the right-hand side, that daily tail for energy obviously stands out. As you can see, it's way up on the RS ratio scale. It's the only sector bringing in a positive return over the last 5 days. Let me add one more here. So, as a matter of fact, over the last 6 days, so including today, energy up 8.2%. That is really the outlier because every other sector was lower last week, including today, with technology down 5.7, healthcare 5.1, communication services down 3.8. And again, these were the sectors that are underperforming the S&P 500. All others, which are above the white line that shows the performance of SPY, have been outperforming the market. But obviously, these are the heavyweight sectors, and when they are lower, they'll pull the market down. Energy, as I said, up 8.2, significantly higher, followed by financials, which was down only 80 bips. And you can see the strength here on the RRG, where it's pointing into the leading quadrant on that daily tail. Now, if we go to the left-hand side, where we see the weekly tails, again, energy stands out with a gain of 14.6% over the last 5 weeks. Backed up by a massive tail, massive long tail, just moving into the improving quadrant. So it has only just begun here. And the real question, I think, is whether that move in energy is strong enough to actually pull that weekly tail all the way into the leading quadrant. We do need a lot of strength, both relative and in price performance, to make that happen. Nevertheless, energy, a very strong sector for the short term, for sure. Looking at the weekly rotations here, you see technology and healthcare now rolling over, moving into or towards the weakening quadrant. And you see financials coming very close to pushing into the leading quadrant. The rest is at not very strong, clear rotations. Similar for, if you just go over the dailies, here is energy, financials, as we said, very strong. Materials picking up, although it is low, relatively low on the daily RS ratio. Utilities picking up at the end of the week, which is good. Energy picking up but losing the pace of relative momentum. Here is real estate moving into the lagging quadrant, so that's losing a lot of its pace. Discretionary, see that long move here, that is actually today, because this was last Friday. This is finishing on the 1st, so this is it. So at the end of the week, that relative weakness for discretionary is picking up. Here we have staples, very close to the benchmark, not really diverging too much. And then we have communication services, inside lagging, picking up a little bit of momentum. Healthcare here on the daily, now moving into the lagging quadrant after a rotation through improving, now jumping back towards lagging. That is not a very good sign, and it is in line with the weakness that we see on the weekly RRG. And then we have technology moving into the lagging quadrant. That's now coming in line with the weakness that we see on the weekly RRG for the technology tail. And here is energy again. So we do see some improvement of the defensive sectors. Utilities, most clearly. Staples, very close to the benchmark. Let's blow that up. and see how that works. You can see that moving. You can see that tail here making its rotations. It's very moves up, and now the last 2 days it's coming down again, so that's not very clear. Although it's very close to the benchmark, so it doesn't take, it's not getting any meaningful direction. It's very close to the benchmark. Utilities are most clearly the one that is picking up here, together with financials. I'm interested in financials, especially with the rising rates that we see. So we see weakness in bonds, which is pushing rates up, and that's probably helping the financial sector. We're going for a quick break right now, and after that we're going to take a look at the completed monthly bars for September. Let's kick off the segment with the monthly charts with a few monthly charts for asset classes. And the first one I want to discuss is the one for the US Treasury bonds, GOVT. That's the core US Treasury bond ETF. And what we see here is that around 27, where I've got that dashed line, I think that's where now we can say safely a new lower high has come into place after this double top. So we have the first lower high and we have a lower low already in place, which means that we are now more or less in a confirmed downtrend. Obviously, more confirmation will come when we break below this low here, and that's around 26. Obviously, that's still 40 cents to go, but that will probably trigger a new acceleration lower. Nevertheless, a new low on the monthly chart for GOVT suggests that we are in a new leg down with the first target around 26. If we break below 26, we will see probably even lower bond prices, meaning higher yields. Second and probably third chart I want to share with you are the ones for commodities. So let's start with DJP, and we can see that after the break, which already took place in April and then held on in May, we had a few months where commodity prices were sideways to slightly higher. In September, we saw another break to, well, not a new high, but above the previous high. And we're now on our way to challenge a very important resistance level just above 30, around 30.50. Again, if we break that, more upside for commodities seems to be on the horizon. And obviously, there is a very nice trend developing here since the start of 2020. And it's now more and more and more turning around this very long-term downtrend. And we'll see a somewhat similar picture when we look at GSG. Again, after the break, a new uptrend evolving on the way to challenging 1870. That's the next resistance level for GSG. And if we break that, we're going to look at 22.5. But again, here, I think the major message is that we're on the way to turning around this massive downtrend that's in play basically since the start of 2008. Massive drop here sideways, and then again a new downtrend starting 2014. So the turnaround in commodities, the new uptrend in commodities, getting more and more or getting stronger and stronger, I think. And then finally, for asset classes, the chart I want to look at is the one for the US dollar. We already looked at that in the other segment, but here is the monthly chart for the US dollar index. Here's the double bottom that we discussed. Even on the monthly chart, that break, that execution is now clear. And This green line, the dotted green line here is the rising support line that broke in the mid of 2020. Question is whether that will act as a resistance level and where maybe this rally will stall, or are we in this big trading range that started back in 2015 between 89 and 104? And are we now on the way up to a renewed test of the upper boundary of that broad trading range for the dollar index? Time will tell, but I think that that dashed line here, that old rising support line, is now expected to start acting as resistance on the way up. Still a way to go, but that'll be probably the signal, the clue whether we are going to see a new high and then a move lower, or we'll break above that former support line and we're confirming that broader trading range, and the dollar index is on its way up to levels of, well, I'd say at least above 100, maybe even 102 or 104. And for the final segment of the show, we're going to look at the monthly charts for sectors. Kicking off with the stock market, the S&P500. As you can see, the uptrend is still there. As a matter of fact, the S&P actually made a new monthly high at 45, 45, 85 in the month of September, and the previous high was the month prior in August, which was 45, 37, 36. So a slightly higher high, but as you can see, the market closed at pretty much at its lowest point. And for those of you who are looking at candlestick charts or are interested in candlestick charts, if you look at that last candle, and let me zoom in to that last bit, that is not a very nice candle. That's an engulfing, it's a bearish engulfing pattern where the whole black body engulfs the prior white body, and usually that is interpreted as a negative sign. So for the first time in many months, we see a real downturn on the monthly charts. So how does that come out in terms of sectors? Communication services closing at the low, making a new high. And I continued to add the downside risk percentages, and we're going to wrap them up in this slide at the end of the show. So here for communication services, the risk, of course, the risk is gotten smaller because the previous month we were coming down, or potentially coming down from this closing level here, which was around 287. Now we're at 268. So the downside risk is getting smaller, but it's still pretty significant. So here for communication services, still between 20 and 30% if you go all the way down to the breakout level. Go to the consumer discretionary, did not make a new high. Risk 7.8 or around 27 when we go all the way down here. Still, again, pretty significant downside risk without hurting the uptrend. That's the crucial thing about these downside risk percentages. These are percentages where the market can come down without hurting the current uptrend, because that is still there in pretty much all of the sectors with a few exceptions. Staples in the uptrend. Here the downside risk has gotten significantly smaller. So here it's 2% until the previous high and around 6-point-something% until the rising support line. Pretty good for a defensive sector, so it supports the defensive narrative, I think. Energy, that's a wild sector, but if you look at the chart, we're still in this pretty big downtrend. The last bit here can be seen as an uptrend, but we ran into resistance here around 410. It's the one sector that had a pretty serious rise in absolute price terms. So for the energy sector, I think we should watch levels between let's say 410 and 420. If that breaks, then we have a further wave up inside this downtrend, and we're going to challenge the 450, 475. So it's getting better, but I don't think we're there yet for this sector. Financials, one of the very good sectors around. Uptrend still there, and as you can see, the downside risk has diminished, has gotten smaller. About 7% until the previous low, 17% until the breakout level. We go to the healthcare sector, uptrend very clearly intact. Here again, this is also a pretty bearish engulfing situation. Downside risk got smaller, it's around 6% until the previous low, and around 14% if you go to this high-low rotation, which was around 1280. Go to industrials, that's an interesting sector because downside risk, it did get smaller, it's between 13 and 19%, but if you zoom in on the last bit of that monthly chart here, you can see a high, you can see a low, you can see a lower high, and we just broke on a monthly scale below the previous monthly low. And that is something that worries me a little bit. I think it basically opens up the way for that decline of 13 to 17%. So the industrial sector is just got more risky, I think. That's the way you should read this. We go to information technology. Obviously a very strong downside month. The uptrend's still there. 16.5% or 26, so that's the downside risk, still pretty significant. Coming down from much higher downside risk, uptrend still there. We go to materials, looking very much like the industrial sector, with the exception that materials has not broken below its previous monthly low yet, and that was 494. So if materials breaks below 494, we're getting into the same picture as for industrials, and it opens up the way for downside until 19%. Also means that that uptrend has then been broken. Go to real estate, very strong downside move. Downside risk got a little bit less, about 6.5% to about 11. If you go down to the breakout level, all in all, the uptrend for real estate is still there. And then we have utilities, not a very clear chart. I think we can say that that uptrend is still there, but we're in the at 319 is about 319, 320 is the previous monthly low. If we break that uptrend that we've seen here, although it's not very strong, is then gone, and the downside risk opens up towards the previous low, which is pretty close to the rising support line, which is downside risk of about 9%. And that finishes off the sectors. Now let's have a look at the wrap at the table where we were wrapping up these all these percentages and these figures. So here's the table that wraps up all of what we just went over. So here are the month-to-month changes, and you can see the big exception is the plus 9.5% for energy. All other sectors are seriously lower. Now, interesting enough, there's a few sectors like communication services, healthcare, technology, and real estate that made a new all-time high intra-month. None of the sectors made a new closing high. And what we see here is that where there was previously only one sector not in an uptrend, energy, industrials with the break below the previous monthly low has now also ended its uptrend on the monthly scale. The other ones are still there. Here are the weights, you know them, and here are the downside risks that we just mentioned on the charts. If you compare it to the September version, they got a little bit less, but in my opinion, these are still pretty significant downside risks, and I'm not sure whether we've seen all the downside that we need to digest the upside that we had. Wrapping it up, new highs 26%, those are the weights of these sectors, 0% new closing highs, and still 92% of the market capitalization weight, that's what we're adding up here, is 92%. And this wraps up Sector Spotlight for this week. Remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. And I hope to see you back next week at the 100th episode of Sector Spotlight. And the planning is to have a very special guest for you to celebrate that 100th episode. So please tune in next week, October 12th, 10:30 to 11 a.m. Eastern on StockCharts television.